Great. So this presentation or webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation of endorsement of any particular security, chart pattern, or investment strategy by Forex.com. This representation or the presentation has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient. And we don't guarantee or verify the accuracy of the information or commentary provided. It will include references to past trading results for discussion purposes only. Futures, options on futures, foreign exchange and other leveraged products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act. And contracts of difference, otherwise known as CFDs, are not available for US residents due to regulatory reasons. Okay, great. Guys, thank you so much for joining. Let's just swap things around a bit. Hang on, bear with me. Oh, that's what I'm going to have to do. Sorry, bring something else up. It's been an interesting morning so far. I know some of you will have maybe read some rather disturbing news that that FX volatility is now at a record low. And I've brought this up to you guys before. What that means, well, on one hand, it's a good thing. On the other hand, it's a bad thing, right? So on the one hand, the reason why volatility or the good news about volatility, I suppose, is that, you know, we're in tight ranges for the major pairs. It's easy to identify tops and lows. Traditionally, that's better for, say, the corporate community or people who might need, you know, who would be in their best interest to have major crosses as, you know, as you know, stable as possible, such as corporates, or if you've got, you know, foreign overseas exposure to the FX market, that tends to be good. For those of us who are looking for opportunities, who like to trend, or trade trends, it can be a bit more difficult, but that doesn't mean that you can't trade. No way at all. It does mean probably a slight change in strategy, but it certainly doesn't mean that you cut that you know, that all is lost. So we will go through a good few pieces of that now. Alan, you're asking me a question. Sterling's going above 170 to 174 eventually. Well, the fundamentals would certainly support what you're saying. We just, as early as this morning, had another sign. We had some fantastic retail sales data. In fact, retail sales on an annual basis now growing at its fastest pace for 10 years. The other, you know, we also had Bank of England minutes, suggested maybe there's a little bit more hawkishness in the bank than we first thought. So all of those things should be pound positive. And indeed, as you can see here, this is just a daily chart. Let me just go back a notch. On an hourly chart, big shoot higher in cable. That was, you know, on the back of that, primarily that retail sales data, even though that Bank of England minutes data certainly helped as well. So looking at it from, you know, from here, as you see, here's 170. We got to 169.95 on the 6th of May. Didn't quite make it to 170. It's really frustrating because I think this low volatility environment largely means that that it just makes that 170 level a little bit harder to achieve. That doesn't mean that it won't, but it probably means, in our view, that we're going to be trading the range for a little bit longer. So a few key levels for you here. So Alan, you sold half your position. I think that's fair enough. I mean, I don't know where you got in, Alan, but hopefully if you'd made some profit on that, that's probably a good idea, because again, right now anyway, you know, even with the good economic data, it just feels like the volatility is so low that it's not really getting us above 170. So wait for some other key driver really would be the key thing. So you got in at 168.10. Okay, all right, well, maybe not. You know, you made a few pips there. Pan, you'll add some more. Well, you know, obviously that's good. Wait for another opportunity there, possibly not right now, in case we are just trading that range. Pan, you're saying that Carney's comments are his housing dampening. Is that bad for cable? Well, no, I mean, essentially, if they're going to be dampening housing market, one way to do that is to raise interest rates, which should be good news for cable. But in the minutes, basically, I felt that the minutes, they sounded quite sanguine on the housing market. They mentioned the fact that mortgage approvals were lower. They also mentioned the fact that, you know, it's really a supply issue. So it's just that the fact that there's house prices going up because there's not enough supply. I'm sure those of you who live in London will probably realise that there actually isn't that much out there, particularly if you're looking kind of the 3-4 bedroom family plots. You know, there really isn't too much, and there's a lot of building going on, but then they take a while to come on board, particularly, you know, apartments and such like. How I see it is that, you know, housing is, the housing market at the moment is neutral for the pound, I think, because I don't think the Bank of England will actually do anything. If you look on a kind of a broad basis, you've got banks actually doing things themselves now. So, for example, you had Lloyds come out and say that they're going to be stricter on lending, that they're going to really withhold lending in London as well, which is key. And so really where that has an impact is actually on those banks' individual stocks. Because obviously if banks are withholding lending, that can hurt their profits down the line. So, for example, today we saw Lloyds come off. So Pan, my view is in the view that my view on that, on the housing market front, is that it actually affects the equity market a bit more than it does the FX market. But if the Bank of England was to go in just like, hammer the housing market down, you do that by raising interest rates, and that traditionally would be perceived as being, or could be perceived as being, good news for sterling. So basically coming back to the technicals here, as you can see, the pound very much still in an uptrend. The reason why I've drawn this blue line here and also this fib retracement is that the first couple of weeks of May, basically since the ECB meeting, we were in a consolidation pattern. We've sold off quite sharply. However, we did manage to find fairly good support there around about that 167.20 level. That is key for a couple of reasons. Number one, 50% retracement of the March to May uptrend. Number two, as you can see, all the way going down to November 2013, all the way up now. That's the uptrend support, so channel support on for cable. So the fact that we held that level does suggest that there is a lot of buying interest. But one thing I just would say is that yes, this trend is ongoing. We've still got a series, as you can see, of higher lows and higher highs, certainly in the short term anyway. I feel like, my lining everything out, my head tells me that we are going to get above 170. Fundamentals are there. We're still in an uptrend. It looks to me like people still want to buy the pound. But my heart is just probably saying, no, just be careful because volatility is so low. Maybe the consequence of that is that people aren't going to be buying and aren't going to really, once we get to that 170 level, they're just going to be taking profit. So any move back towards that 169.90 level could attract some selling, whereas it does seem like 168 was the low, 168.02 I believe was the low from yesterday, from the 20th, and then of course we then get that 167.20 to 25 level. They're key support levels that seem to be attracting buying interest on any pullback. So that for me, I'm still looking at the range for now, even though I do think cable does look fairly good. Add to that, looking at the momentum indicator, the daily MACD, we've crossed we're above the zero line. That's just mild bullish momentum, but we haven't yet got that bullish crossover, but we may do, so we'll be watching that very, very closely. The other thing to point out is, oh, sorry guys, let me just move this out of the way. The other thing to point out as well is, what's my opinion in euro dollar, Alan? Pan, you're still long the pound. Well, that is good for you. Alan, yes, euro dollar. I will come to that in one moment. I'll just pull up my other chart, just bear with me. Okay, guys, sorry about that. I just had a bit of a problem with my Bloomberg chart, and I'm just trying to fix it now. So just bear with me. Sorry about this. Me and the Bloomberg help desk quickly. But there we go. All right. Okay. Right. It looks like it's back up and running now. That is good news. Let's take a look at euro. I've had a couple of things. Some people have been looking ahead with euro, I think, purely because we obviously had that sharp sell-off. If I go back to the daily cloud chart, I know those of you who joined me last week will know I love a good bit of oh, what's happened here? Yes, this keeps happening. I'm sorry. Okay, so that's fine. I find the clouds interesting, good things to look at, and especially when we do seem to be trading sideways a bit, or we're not getting a lot of follow through in the markets. It's good just to see, just to get a sense of where we are. So what this chart shows us, this is a daily Ichimoku cloud chart for euro dollar, is that we fell through the top of the cloud, so that upward the upward momentum seems to be over. We've fallen through the cloud, and we're now just hanging around the base of that cloud, hanging around here. So what it suggests to me is that we're not, even though we are below the cloud, because the cloud top comes in at 137.26, we're currently trading 136.72. We haven't yet made a real kind of break for the border on the downside. This we'd have to get through this low from the 15th of May here, which comes in around about 136.50, for us to be quite negative. Now we are quite close to a key level of support here, and that also seems to cushion the downside. Let me just draw it for you here. So it's this level here. So 61.8% fib retracement of the February. It used to be February till March. It was then February till May uptrend. That comes in 136.95. So we are actually below that level now. Be interesting to see where we close, because we haven't closed below that level yet. There is a lot of selling pressure on the euro right now. We've seen quite a lot of, euro. There hasn't been too much on the economic data side of things, but it'll be interesting to see whether or not we get closed below there. So do watch out. I know, who was it? So Alan, you're looking at, the euro dollar. Is it time to go long yet? I would say just watch out where this closes, because I have a funny feeling if we get below 136.96 or 136.90, daily close below there, could actually get us back to those February lows, which come in around about 134.77. So just be a bit wary. I know, it's been really frustrating. A lot of people have been seeing euro dollar come off very, very sharply post the ECB meeting, and then people saying, oh, well, actually, no, I'll just buy it from here, because number one, volatility is a bit low to sustain a downtrend, maybe. Number two, what if the ECB doesn't actually, come back and say anything? What if they actually don't come back and say anything? What if they don't do anything at their next meeting? I'm going to hedge my bets. I'm not going to go too far on this. I don't want to, stretch it yet. So just watch out for that. I see the arguments on both sides, but I would be a bit wary of that close below 136.95, particularly if we got closed below 136.70. I think would be quite bearish in the short term. Now, Himashu, you're looking at dollar yen. Well, dollar yen has been one of the most interesting pairs so far today, and that's because, look, we got below the 200-day moving average. That is the yellow line on this chart. Let me also draw another line in here. We also got below support that we've managed to bounce off 3 times since March. That is a key development. This comes on the back of the Bank of Japan meeting. So, Alan, you look like you've been going the right way, which is good. You're still long the pound. You're looking to go long the pound again, but your shorts on your dollar yen from 102.30, and it's hit the target, which got to 101. Well, that was good. I know it took a while to get there, because we were obviously kind of meandering about. The range wasn't very high. What we're seeing now instead is what we've seen right now anyway, is this kind of steep sell-off on the back of what has happened on the back of the Bank of Japan meeting, and the fact they didn't take any action, the fact that they didn't sound too worried about what was going on. That was kind of the key thing to note there. Himashu, just looking at dollar yen, we need to get a daily close below this level. So a daily close below 101.20, preferably below 101, would be, could potentially suggest that we then get to the lows. The lows of the year so far have been 100.75. So what I'm saying is that we've had this low, we've got through this key 200-day moving average. When that happens, it can be a sign of further downside to come, because that's such a massive level. A lot of people in the market were looking at it. But then you do have kind of, will the market actually want to push us below the annual low, the year-to-date lows, which, as I said, come in at 100.70. Just double check that for you guys. 100.76, which was a low from the 4th of February. I'll just bring up my other chart as well, because then we can look at some momentum indicators. As you can see here, well below the zero line of the MACD, that suggests bearish momentum. On the very short term, though, we have bounced back a little bit. So as you can see, we got to that low there around about that 100.80 level. That was the low so far today. And now we're just kind of bouncing back, just turning around. So that could be well worth looking at quite closely. So we've, at the end of the day, it doesn't look right now like we're going to make a massive recovery. 101.25 is the 200-day moving average. We're still, some way from there. We're only trading around about 101.07 at the moment, or thereabouts. We're essentially still trading in quite a tight range. I'd be interested to see where we close today, though. Obviously, as I said, is that right? If we get a daily close below that level, it's going to be pretty important. Himashi, you also want to look at euro yen. Euro yen, obviously, with the euro being weak, the yen being quite strong, quite a bearish development, as you can see. So that is an hourly chart. Nice trend lower there in the very short term. Crossover in daily MACD well below the zero line. Momentum very much to the downside. As you can see here, again, we are getting back to those. We are getting towards that territory where the February lows, which came in around about 136. Come back into play. Let me just pull up my other chart. Now we do have this massive level of support to contend with, which is the 200-day moving average, which comes in at 103.08. It looks to me like the market is going to target it. Obviously, we've been below the 200-day moving average in the dollar yen. If we get a daily close below there, then that could easily see us back to those lows of the year so far, as I mentioned. Fred, you're looking at copper, which is a bit of a knife. I assume you mean maybe falling knife. To be honest, I haven't really looked at copper. Copper could be very volatile over the next 24 hours. Why, you ask? Let me just pull it up. I'll just see what the active contract is actually doing. Again, as I said, I'm not the metals specialist. My colleague Fawad looks much more at metals. As you can see, yes, very, very sharp decline there. We do have the Chinese first reading of the May reading of the manufacturing PMI. That always tends to get some volatility moving in the markets. Obviously, copper, China's a very important market for copper, so the fact that it's falling ahead of the Chinese PMI, that could be one reason why, that maybe there's some expectation of that being quite negative. It also got below the 100-day moving average, so that could be more of a technical move. From where we are now, obviously 310 is a key psychological level in the very short term. So I agree with you. It's looking quite, it is, certainly in the short term anyway, a lot of volatility going on in copper. When that happens as well, to always take a look at Aussie. I know lots of you are asking questions. Just bear with me, guys. I'll try to get to them all. I've got to try and give everybody a chance anyway. Always look at Aussie. And indeed, look, the Aussie has absolutely fallen through its 50-day moving average. That looks a bit like a knife as well. And the reason why I mention that is because obviously you've got copper and the Australian dollar. The Aussie dollar can sometimes move with metals. Now, it's diverged many times with metals. For example, from this up move from January all the way to April, metals were coming, or commodities were coming off, and yet the Aussie was going higher. It looks like that relationship might be coming back into play. Let me just create a chart for you here. I'll do it very, very quickly. Hopefully my Bloomberg doesn't play up again. So here you go. As you can see here, copper and the Aussie, not the most perfect relationship in the world, but they have been moving together. Just to point out as well, guys, this is a Bloomberg chart, by the way, and some of these products won't be available to US clients from forex.com, but these prices aren't based on forex.com. These are Bloomberg prices, but I'm just using it as an illustration of how they've been moving together. So again, I can't remember who it was that mentioned that copper is a bit of a falling knife. But when you see copper fall off quite sharply, take a look at what Aussie is doing. The Kiwi's also weaker today, and it may have something to do with that data coming out of China tomorrow. Let's take a look as well at euro sterling. I know someone's asked about that, and they've waited very patiently. As euro sterling is very, very weak today because sterling was higher, and you've got euro being weaker, against the dollar. So that's not helped. It's been a bit of a toxic mix. As you can see here, I mean, it's just looking so weak at the moment. We're back below 81. Where does this leave us to? Where does this lead us to next? Well, it's interesting that euro sterling is falling as well ahead of those EU elections. Tomorrow is the start of EU elections. We're putting out a piece later today that will basically show why EU elections could matter for markets and how it could weigh on the euro. So do watch out for that, because when we get below here, there isn't too much weight in the way of support. You're going back to those 2012 levels when we got back to 80. So if you're going on holiday to Europe, then buy lots of euro. Then now may be a good time to buy lots of euros because it's quite cheap if you're converting it from pounds. Okay, Alan, I know that you mentioned dollar CAD and you mentioned our rivals. How dare you? No, I'm only joking. I'm sure that they've made a good decision, whatever that may be. They've entered it. You had mentioned about our rivals entered long at 10.90. Oh, sorry, no, maybe you mean 109.10. And basically it does look like there's been a bit of a reversal, and that we could see a bit of upside in the CAD. First things first, just to say, is that the markets sometimes diverge and don't move together, but it seems at the moment, or the last couple of weeks, we seem to have a situation whereby we are seeing things come back into place. So, for example, commodity currencies are moving together, risk on, risk off, that type of thing. I wouldn't say that's the best environment to be in. It's often not, but it can make things slightly easier to understand. So, for example, here, as you can see, we have bounced off. We didn't get to those lows. The CAD is coming under some pressure, maybe alongside what the Aussie's doing, what the Kiwi's doing. We did mention in our webinar on Monday that this 108 level, this was a key reversal earlier this month. The fact that we didn't get down to it suggests that that is a massive level of support. There is a lot of buying up there. And now that we've managed to get above it, we've got a bit of a mini uptrend, I would say. So a very short series, we've got 3 series of higher lows. And that can be, certainly there's momentum on the upside for dollar CAD, at least in the short term anyway. I'm hesitant to get back in because you think it might test 108. I mean, indeed it might. But as I said, at the moment anyway, it looks like it's, it's managed to hold on. But that 108 is a massive level of support. So if you are hesitant thinking that it's had a big enough move, we do seem to, 109.30, which is the highs from the 13th, 14th of May, is quite sticky resistance. Now, a colleague of mine, if you go on our website, forex.com, my colleague Matt Weller actually wrote about dollar CAD. He was looking for a bit of bullish reversal as well. So it's interesting for him. It might be interesting for you guys to follow up with what he was saying. So overall, as you can see, a hell of a lot's going on in the markets. It looks like maybe some volatility is coming back. There's an awful lot of fundamental risk going on, and not least that European election. I know for those of you looking at euro and euro sterling, that's certainly something to keep note of. The election voting starts on tomorrow, so 22nd to 25th, and we should know the results on the 25th, and then on the 27th, Tuesday the 27th, EU ministers will meet to discuss the outcome of the elections. The risk is, I think, still some anti-establishment parties, particularly in Greece. Do you remember those Syriza party? That was kind of way back in 2012, nearly brought the end of the Eurozone because they were so anti the bailout. Well, they've got a bit of momentum going into these European elections, even though the ruling New Democracy Party have actually been able to capitalise on some better economic data recently. So they're about neck and neck. But if we see if we if we do end up seeing a win for the Certia party, then essentially what that could mean is that they may push for a national election at home, which could tear up the bailout and potentially bring us back to the sovereign crisis that we saw from 2010 to 2012. And now a crisis, for those of you just reversing back to our volatility piece, what I said at the beginning, that volatility is quite low. Well, the reason why it's low is because of different things, dynamics in the market, but also because we don't really have a big crisis going on. So if you are one of those people that like volatility, always looking for opportunities, then maybe the outcome of this EU election will actually trigger that volatility, because it will be another crisis, which could potentially weigh very heavily on the euro. But as I said, just because the major pairs are trading in quite a tight range, be that dollar yen, even though it looks like it could have broken to the downside now, euro dollar and cable, doesn't necessarily mean that there aren't opportunities elsewhere. As you can see, dollar CAD is one. We've also got euro sterling. All of these things are really interesting to watch out for. Now I'm going to end looking at the dollar index, because that still is a really key thing for where trends can go next. The dollar index looked like it was in recovery mode earlier this month, but it has just really stalled. We're consolidating. The next, I think, 2 to 3 days will be really important. If we get below 79.83, that's the 50-day moving average, that could be that could suggest that maybe the dollar uptrend is just over. The dollar's lost its gas, I suppose. But again, a break above 80.20 would be quite a bullish development, and suggest that maybe this dollar recovery has further to go. But do watch out for those EU election results to see if that's the case. Now, guys, I'm going to leave it there. I know that it's been a real short one today. It's been nice and quick. We've had lots of things coming, lots of other stuff coming. Unfortunately, I've got another appointment, so I have to leave. But it's been really good for you to join. And this is an unusual time, I know. So thank you all for joining. Please do join us next week for our FX Street webinar. It's at the normal time of 11 o'clock. But I'm really pleased that so many of you are there. You ask great questions as always. And again, thank you so much. All right, everybody. Bye-bye.